Evening and welcome to Evening with the Fed. I apologize for our brief delay. Of course, there are always some technical difficulties. I'm Trudy Hall with the Economic Education Unit of the Public Affairs Department at the Federal Reserve Bank of Kansas City. Thank you so much for joining us this evening. This is the final installment of our Evening at the Fed series. And our program tonight, the coronavirus shock, implications for the economy and monetary policy, features Esther George, President and Chief Executive Officer of the Kansas City Fed. In her leadership role, President George is responsible for the 10th Federal Reserve District, covering the western third of Missouri, all of Kansas, Colorado, Nebraska, Oklahoma, Wyoming, and the northern portion of New Mexico. President George participates regularly in monetary policy discussions with the Federal Open Market Committee. The program will include a Q&A session moderated by Tim Todd, executive writer and historian at the Kansas City Fed. Tim is the author of several books on the Federal Reserve, and his latest, Let Us Put Our Money Together, the founding of America's first Black bank. All are available on our website. If you have questions, please use the Q&A box and let us know where you're from. We'll try to answer as many questions as possible. The chat box has been disabled. Please use the Q&A. Now, it is my pleasure to welcome and turn the program over to Esther George.
Thank you very much, Trudy, for the introduction this evening. And let me say to all that have joined us, good afternoon. It is a pleasure to be part of this series as we wrap up our Evening with the Fed program. As a regional Federal Reserve Bank, it's our goal for the public to understand what we do, both the work we do and for individuals to understand the important role that they play in our economy, whether they are going to school, going to work, and certainly as they save and spend in this economy. The U.S. was hit with an unprecedented shock last year that threatened the health of the American public, as well as the economic well-being of our country. And so in my talk this evening, I'll review briefly the experience of the past year, but importantly, the progress that we're making to recover from that experience as it relates to our economy. I'm pleased to say that by and large, it is an optimistic outlook. You may or may not know, but my colleagues and I across the other 11 Federal Reserve banks, as well as the Board of Governors in Washington, D.C., meet about every 6 weeks or so to talk about the state of the economy and to understand how interest rate policy can affect financial conditions. We had one of those meetings last week, and after each one of those meetings, a statement is issued that tells the public what we talked about. And following the release of that statement, Chairman Jay Powell holds a press conference where he answers questions by reporters about the nature of the economy and how we see it based on our meeting. And I think from that most recent press conference from our meeting, you would hear that there is encouraging progress in the economy right now, even as the Federal Reserve is keeping interest rates very low to make sure that the economy can continue to recover. Since the beginning of this year, the U.S. in particular has made considerable progress in containing the virus. That's been good for the health of Americans, and it's also been good for our economy. In fact, by many economic measures, we've made up a lot of the ground that was lost from the extraordinary events that unfolded in March of last year. When we measure real GDP, during the first quarter of this year, it grew about 6.5%. And that really puts us very close to having made up the losses that came about over the past year. And I expect as we see growth in the second, third, and fourth quarters of this year, that that's going to continue. We still need to make some more progress in our labor markets. Although there too, we have seen a great deal of progress over the past year. The unemployment rate today stands at around 6%, compared to what it was a year ago when it peaked at about 15%. So that is a lot of progress in the labor markets, but it is still a fair distance from where we were pre-pandemic, when the unemployment rate had gotten down to 3.5%. And of course, the unemployment rate today doesn't really tell us how many other people have actually dropped out of the labor force and are no longer looking for work. So still progress to be made there. We also know that the labor markets can look very different across the country. And I will tell you, just in the region that I serve, if you look at a state like Nebraska, you would find that today already the unemployment rate is below 3%. On the other hand, if you went further west and looked at a state like New Mexico, their unemployment rate is still higher than the national average at well over 8%. So a lot of variation is going on in the labor market today. And I expect as the virus continues to fade as a concern, that we will see more progress on the employment front, particularly in those parts of our economy that were hardest hit. So when you think about restaurants, entertainment, hospitality industry more generally, those are beginning to come back. In my own region, we see manufacturing is very strong today. We see the energy sector is beginning to benefit from higher oil prices. And of course, farmers and ranchers in our region are beginning to see higher crop prices, which brighten their outlook. Importantly, as the economy is able to fully reopen, the tremendous fiscal stimulus that was provided last year and early this year is likely to continue to support the healing and growth in our economy. Households in particular have received considerable transfers from the government, and they have been accumulating savings well in excess of what they would normally do. And I expect that additional savings or money in the bank that people have today is going to support strong consumption growth as we go through the rest of this year. In fact, the outlook is so strong at this point that the discussion we are having about the economy has shifted from concerns about whether there would be enough demand and consumer spending, and now is looking more at worrying about supply constraints, as we begin to see more evidence that in some categories, demand is beginning to push up on available supply. So as this outlook unfolds, there are going to be things that I'll be watching for in the economy to understand how might the economy look a year from now. And the kinds of things I'll be looking at are really three areas. One is, how enthusiastically will consumers spend this money that they've accumulated? The second issue is, will some of these supply constraints or these bottlenecks that are running up against that demand constrain people's ability or urge to spend? And the third thing that the Federal Reserve must always keep its eye on is, when strong demand hits those constraints, how will the effect be on inflation? Will that be temporary until more supply comes on, or will we see a more persistent rise in inflation? So let me talk about each of those briefly. First of all, the question of how quickly will consumers spend the money that they have right now? And the pace of growth in our country will depend importantly on how that money is spent. Right now, when we look in aggregate, people have paid down debt. Many households are in a better position today. So they certainly have more capacity to spend than they might otherwise. But the question is, will people want to? And what do I mean by that? I think there are a few reasons to think that people might want to hang on to the money that they've accumulated, at least part of it, for a while. And I say that because households are now aware of some new economic risk that might not have been a consideration for them over a year ago. Now that they've experienced what an economic shutdown can look like, they may want to remain more liquid than they had in the past. In other words, to hang on to some of that money as a buffer. And I think people also understand that those fiscal transfers are temporary. At some point, those transfers will not be coming in. And so that will also cause, I think, people to be careful about how they think about spending. So how people spend over the next year is going to be an important thing to watch, I think, for our economy. The second issue that I mentioned has to do with supply constraints. And you probably are experiencing or hearing about some of those now, whether it's lumber, whether it is a chip shortage that is affecting the production of automobiles. We are going to have to watch how materials and labor may be in short supply while we see this boost in demand. It might seem odd to talk about labor shortages at a time when I just told you that we have an unemployment rate that shows some 8 million people out of work today. And the reason that businesses may be having trouble finding workers today has something to do with the still depressed level of participation in the labor force. In other words, those people that have actually quit looking for work for a variety of reasons. How quickly companies are going to be able to hire to produce the supply they need to meet this higher demand is likely going to depend in part on the specific drivers of why people might not be looking for jobs today. Some of that decline we know is directly related to the pandemic, either because there have been restrictions on activity. So you may have had a job in a sector that really hasn't come back yet. And so you are just waiting until the economy fully reopens. In some cases, we know a number of people have had to drop out of the workforce because they haven't had access to reliable childcare, or they've had situations where caring for family members have kept them out of the workforce. And we even hear anecdotes about people that still are afraid of the virus in terms of getting out and getting back to work. So as the pandemic fades, these factors are likely to reverse, and some of these labor constraints that businesses are experiencing today should ease. It's also possible that some of the decline in the workforce today will reflect people's detachment from work after having the last year of these workplace disruptions. And that might be particularly true for workers that were getting close to retirement anyway. So in this case, I think it would take a period of very strong growth in our economy to draw some of these workers back in. So we'll be watching for that. The third issue that I want to touch on has to do with inflation. And I hear a lot of people today asking about what's going to happen to inflation as we see some of these shortages, as we see prices rising, whether it's for houses or cars and other things. When you look at the inflation numbers last week, they were up. They were up to about 2.3%. And that really reflects the fact that if you looked a year ago, prices were low. When the economy was shut down, we didn't see much inflation. And so now, a year later, we are beginning to see prices rise. Some of that, of course, is going to fade as more supply comes online. But right now, it's really hard to tell how much of the inflation pressures are going to be temporary and how much of those might persist. And that's because right now there is a wide dispersion across different sectors of the economy. If you're in the services industry, If you're in one of these businesses that I mentioned that have not been able to open up fully yet, you're not seeing much pricing power there. On the other hand, if you're in a business where people are buying things online or you're producing goods in some way, we have seen pretty healthy price increases there. Recently, I looked for a rental car, and if any of you have done that, you know that you will see a little bit of sticker shock right now. But I would expect that as more supply comes online, we would see that begin to dissipate. So the third thing I'll be keeping an eye on is going to be inflation. We'll watch and see how consumers spend. We'll see whether these supply constraints work their way through and what effect that has on inflation. So what does that mean for the Federal Reserve's decision about what to do with interest rates? Well, right now, we are keeping things low in terms of interest rates. We are making sure that the economy has access to very accommodative financial conditions while this healing process continues. In fact, the FOMC, which is the Federal Open Market Committee, the committee that I participate on with my colleagues, has indicated that it expects to keep interest rates near zero until we see the labor market get back to full strength and we see inflation remaining at that 2% over some period of time. Based on that, you might expect that interest rates will be low for some time as we make sure that we provide supports to the economy. I want to close my comments with all of you this afternoon by mentioning what might be the longer term effects of this pandemic and what might we see when we get to the other side in terms of the economy. One thing that I think we will all witness over the longer term is that this pandemic has either accelerated or launched important changes in a number of aspects of the economy, and it could take some time for those to play out. In particular, right now, this transition to virtual work for many of us has likely loosened the hold of geography on many forms of economic activity. So your ability to live in a place different from where you work is becoming more familiar to many people. And that, of course, has implications for real estate markets, both for commercial real estate markets as well as how businesses assess their office space needs. And it certainly has implication for residential real estate as individuals think about where they can and want to live. The pandemic has also, I think, accelerated us to a more digital economy as more activity than ever has moved online. And you and I have both experienced that. Not only did we have to order more things online, but paying for them in that same way. And so as we watch how the economy unfolds, I suspect that some of those trends of online ordering, online retail will continue to be prevalent for some time. So in a world that might be experiencing changes like this, I think one of the things is how do you and I, how do workers prepare for a different economy? And for this audience in particular, I think you will appreciate something that I think is so important, and that is education is going to be key to that. It's important to stress that a changing economy is not only about challenges, but it is also going to present opportunities for people. Workers that have the right skills and the flexibility to use those skills in a shifting environment are going to be the ones that are best positioned to take advantage of those new opportunities that a dynamic economy can provide. And an important attribute for that kind of success is likely to be the capacity and the willingness to be a lifelong learner. In practical terms, that means that learning how to learn is likely going to be as, if not more important, than learning a particular subject or a skill. And so taking a wider view, I'll just close by saying education is not only about the gains to individuals. Education, of course, has a large societal gain as well, meaning that the human capital that we build, the skills and capabilities of a country's labor force is an important contributor to our standard of living in this country and to our economic well-being, as well as the growth that we might enjoy here. So investing in education, I think, has tremendous and important rewards for both individuals as well as our economy as a whole. Thank you very much, and I look forward to taking your questions.
Thank you very much, Esther. My name is Tim Todd. I work in the Public Affairs Department at the bank, and I'll be acting as our discussion moderator this evening. If you have a question, please submit it in the Q&A feature of the application, and those will come to us, and we'll be asking Esther your questions. We really want this to be a discussion that's motivated by your interests, so if there's something on your mind you'd like to talk about or learn about, just let us know and send us those questions. We do have a few beginning to show up, but to kind of kick us off a little bit, our audience is a broad group from different disciplines, different backgrounds in understanding the Fed. So could you talk a little bit about your job, your role as a regional Federal Reserve Bank president, and what a regional Federal Reserve Bank does?
Yeah, Tim, let me start by saying the Federal Reserve is the nation's central bank. In other parts of the world, central banks are really monolithic institutions. They usually sit in whatever the capital or headquarters of a country is. In the founding of the Federal Reserve, Congress decided that the best way to serve the American economy and the American public was to have a more decentralized institution. So yes, we have a group in Washington, D.C., Chairman Powell and other members of the Board of Governors, but you have 12 regional Federal Reserve Banks that are spread throughout the country, including the one here in Kansas City, whose job it is to carry out the mission of the central bank by connecting us very closely to the regions that we serve. And so in the introduction, you heard about the region that the Kansas City Fed serves. And we really have three key jobs. Our job is to get input about the economy so that when we deliberate on national interest rates and what the right monetary policy should be, we are well informed from all segments of the economy. As I said in my remarks, the way things look in Nebraska can be very different than the way things look in New Mexico, and that is true across the country. The second thing we do is to make sure people have access to credit through our supervision and regulation of the financial system. And of course, we play an important role in making sure that the payment system in this country operates with wide access, with safety and integrity around that. So my job as a regional Fed president is to make sure that the team of people that work here in Kansas City, at our offices in Denver, in Omaha, and Oklahoma City, have the resources they need to engage with the public and to carry out those important functions.
I'm going to take our first question from teacher Carol Mathias as a question that's it sounds like it's actually coming from students. They've been learning about inflation this week, and their question is, if the minimum wage is increased, will that create an inflationary environment? So we'll start things off with a tough one there from the students.
That is a very good question, and I'm so glad you're thinking about the connection between wages to a more general increase in prices in our economy. One of the things over the past decade, the reason that we haven't seen a lot of inflation is that we have a really global workforce. You see companies that can use labor really in any part of the world. We have an economy whose structure has shifted to more service-oriented jobs. And so the level of wages relative to the cost of things we pay for has been relatively muted. We've seen inflation stay below 2% for a long time. Your question about whether raising the minimum wage will cause all prices to rise is one that we will have to watch and see. So the question is, who will get the increased minimum wage? To how many workers will that apply? And will those companies simply turn around and pass on that cost to consumers? Or will they find other ways to operate before they do that? And that is something that is my job and that of my colleagues, is to watch. Do increases in the input cost, of which labor is one, end up being passed through to the rest of us as we consume? So it is a great question. It will be one of the factors that my colleagues and I will watch. By itself, a raise in minimum wage doesn't necessarily mean that that will automatically translate to inflation, because companies have other things they can do before they pass on those costs. If they have a hard time getting workers and have to raise those wages more generally, we could certainly see upward pressure on inflation.
We're going to a number of inflation questions, which I guess is not surprising. That's sort of the thing people are talking about in the public sphere. Could you talk a little bit about oil and gas prices and what we're seeing there, and potential impact on inflation? Obviously, our bank serves a district that has a lot of energy assets, a lot of energy development in it.
Yeah. So let me take you back about a year ago when the economy shut down, when planes quit flying, when we quit doing a lot of business travel. We saw the price of oil briefly go negative. That had never happened in my career. Now it's come back quickly, and you see it begin to rise now because, again, as people are traveling more, as we are getting back to work, the transportation that it takes to deliver all the goods we're ordering online has really been a boost to oil and gas prices. The question is, how, again, does that pass through to you and I? Well, certainly we will see it at the gas pump as a higher price. And one of the ways we measure inflation, certainly the price that we see at the gas pump gets added into that basket of inflation. But we also know oil prices can do this. They can go up and down depending on what's happening in the economy, just like the price of food can. And so there are two ways we look at inflation. One is what we call a headline number. That will include those higher oil and gas prices. And we see today that's about 2.3%. Because those prices are so volatile, if we try to take that out and say what's underlying inflation, which we also refer to as core inflation, you see that number is only 1.8%. So we're watching both of those, right? Because headline inflation is actually what you and I are experiencing. We don't get to take out some of those things from the basket of things we buy. But when the Fed is thinking about how inflation is working more generally in the economy, we might look at things like energy to see how that's affecting the prices of things.
Another question, and one that we have seen increasingly in the last couple of years, I would say, is issues of inequality, economic inequality, and this continuing what appears to be a widening of the gap. Can you talk a little bit about that, and what can the Fed do, and what are, I guess, what's the solution and what's within the Fed's toolbox?
Yeah, so there's a lot we could say about that. And one of the things we have seen in this pandemic is the unevenness with which it hit our economy and it hit workers. And here's what I mean by that. Even as the economy shut down, you and I were able to go online and order things. In fact, we saw sales of bicycles and laptops and other things, exercise equipment, really take off during that period, because while we were closed in, we were still able to transact. But if you were in a sector of the economy that literally was shut down, anything from a movie theater to a restaurant to your dentist, you would find that those sectors were disproportionately affected, which meant the people that worked in those sectors were disproportionately affected. When we look at who is working in hospitality, who is working in hotels and restaurants, and many of those services in our economy, they are disproportionately represented by people of color and by women in many cases. And so this shock has had a disproportionate effect, which means its unevenness is felt very much. When the Federal Reserve responds by making interest rates low, it is an attempt to get the economy to make it easier for people to borrow. But of course, if you are without a job, if you have low income, your ability to take advantage of that is harder. And so it's one of the reasons that the Federal Reserve is focused on keeping conditions accommodative so we can draw more people into the economy by keeping growth strong through those interest rates, by encouraging businesses to hire and hopefully close that gap. We saw that before the pandemic. In January of 2020, we began to see the gaps in employment rates between whites, African Americans, Hispanics begin to close. And that had everything to do with having a long expansion and an economy that would work. So one way the Federal Reserve responds is we can't really fine-tune interest rates, but we can try to balance the ability to keep the economy growing in a sustainable fashion so people can get back to work. The other thing we do, Tim, importantly, I think, is through our community development efforts, is to engage in our communities to make sure that the resources that are available to people, that issues of access to credit, how is it that people can become more self-sustaining, whether it's access to housing and other things. Our efforts in the community development space are really designed to help solve for some of those problems, certainly that interest rates can. So bringing people together to really try to find those solutions is important.
Our next question comes from Claude, and Claude is a digital economy specialist. You talked a little bit about some of the transition of the economy that we've seen through the pandemic period. And so Claude's question is the central bank prepared for a transition from the traditional economy to a digital economy? This question is primarily on the regulatory side, but obviously there's other sides with payments and various things as well.
Yeah, I think this is going to be one of the most dramatic and long-lasting changes in our economy, is that things are becoming more digital, and that is certainly true in our financial system. And it is certainly true for the work that the Federal Reserve does. So for example, we know now that people want to be able to make payments using their mobile phones. And they want to do that in real time. And so the Federal Reserve is undertaking work to build an instant payment mechanism that the banking system can offer to their customers, so that when they want to pay for things, they can do that instantly. When businesses need to balance their cash reserves with the inventories they need, they don't have to have delays in doing that. So the Federal Reserve itself is beginning to modernize its intersections with that financial system in more digital ways. The Federal Reserve is also looking, as many central banks around the world are, is whether our money should become more digital. And so thinking about digital currencies, right now we hear a lot about cryptocurrencies, which are essentially private money being created. Central banks will also have to think about whether the currency, the paper money we use today, will at some point in the future lend itself to using more digital ways to make those payments. This is going to be an area that I think will change a lot of how we work, of how we transact business. And the Federal Reserve, certainly as a regulator and certainly as a provider of payments in our economy, is going to have to really stay up to date on how that unfolds.
The next question is from Daniel Owens, and he actually submitted this question while you were making your remarks. He was the first one in, so I think we should ask his question. Since he started studying economics 40 years ago, Fed leaders have become much more open and transparent about policy views, their thoughts on economic conditions, and the outlook. Can you maybe talk a little bit about the value of that transparency for both economic policy and why it's important in a democracy to have that transparency?
Yeah, That is a great question, and it's one that I think is so important to our country. When you have a public institution, it must be highly accountable to the public. And one of the ways that I think about that for the Federal Reserve is that you have to be very transparent. Our decisions about monetary policy work better when the public understands what we're trying to accomplish, how they might anticipate we would respond to different states of the economy. So transparency at that level, I think, is very important. 2 decades ago, the Federal Reserve might change interest rates and no one would know until at some point later it showed up in their bank lending rates. Today, the Federal Reserve is much more open about how it's thinking about its forecast and how the actions it might take can be anticipated. I'm also mindful that transparency is not just about more information. It doesn't mean you will be clear in your communication. And so my colleagues and I are very mindful that the clarity of that communication is equally important. That not being clear, being confusing around that can be a problem. And the last thing I will say to that question is transparency is important in a democracy to know that there are differences of views. And one of the things I have always valued about my colleagues around the Federal Open Market Committee table is that there are a difference of views that come to that table and they make our decisions better, in my view. I think the credibility of a large committee like we have is made stronger when those different views come out and when the public can see that. So from time to time, you will find that even as the Federal Reserve makes a decision, you may have dissenting views that are also highlighted in that. And even though our meetings are very collegial, it is important, I think, in a democracy that the public can see those different views are represented, they are respected, and ultimately that accountability is really to the people that we serve. So a very important issue for central banks and for the Federal Reserve in particular.
A question about the types of workers, because obviously you're a CEO of a large firm, large number of workers in Kansas City and also our branch locations in the district. And one of the things, you sort of talked earlier in your remarks about the adaptability of workers and the last question about, 40 years ago, the Fed at that time, we had paper checks coming in and they were flying all over the country and all these things. And the adaptability as an employer, the skills you look for today. Could you talk a little bit about that?
Yeah, I think if anything, I said in my remarks, the flexibility to make sure you can learn how to learn, I think is going to be critical. I think back just in terms of, we were talking about the digitized economy that we're experiencing. It used to be that we would tell students, and I did the same thing, go to an IT class. You would sort of compartmentalize, how you would think about technology. Today, of course, technology is everywhere. Technology affects how we communicate. It affects the amount of information that we have to analyze and look at. It enables things that we might not have imagined even a few years ago, to be honest. And so I think for workers, I think for people that are going to school, thinking about what is it I need to know, technology is going to be around us. And I think at a minimum, we should anticipate that what we think we know today, what we think the skills are we bring to a job could change, and they could change very rapidly. So I think for all of us, being very open to saying, how is what I'm doing today changing? What is it I need to learn and expand about what I know is only going to become more important. And I say that not as a challenge, but this presents a tremendous opportunity for people. I've watched in some of the jobs programs, Tim, where people that have lost jobs, people that are well into their 50s and even 60s who say, I can't do IT. We've actually found they actually are pretty good. It has to do with your aptitude and willingness to learn. So it is as much about being willing and sort of having your radar out about what is possible. And that really will open the door, I think, for a lot of people.
Are there any lessons you think that students can draw from this pandemic period? I know when you were talking a little bit about how we'll be different in some ways, it brought to mind my grandparents when I was very young, and they'd been through the Depression, and my grandmother had, more canned goods than she would need for the rest of her life all the time. So what kind of lessons do you think students can take as they look forward into their lives?
Yeah. Well, I think students in particular have had to learn some hard lessons probably over the past year that will stay with them, and I think will be helpful to them for some time. So first of all, I think students have had to figure out, just like you and I have, that social connection we had with school, with work, got disrupted pretty quickly. The engagement with friends and with colleagues, and we had to learn how to do it online. Those sacrifices, those new ways of learning, I think will benefit people. I think a certain resilience came along with this. And I think for all of us, we've learned how to do things that we might not have imagined in different ways. I think that skill, that sort of flexibility will pay off for some time. I think the other thing this experience has reminded me, and this is more in the financial realm and thinking about financial literacy, is none of us could have anticipated or expected that we would see the economy shut down. And some people, I think, will keep this lesson in terms of, am I prepared for the unexpected? We often are reminded, be prepared in the event of a storm, be prepared if your electricity goes out. I think all of us have been reminded financially, we should think about how we prepare ourselves, whether we have resources to draw on when things that we would normally do aren't there. So I think students will carry this experience with them for the rest of their lives. And I hope in whatever ways it shapes them, it reminds them of what they were able to do during a very difficult period. I hope that for all of us that work here at the Federal Reserve too, Tim.
Going to be running a little bit longer, a little short on time though. So if you've got any questions, go ahead and put them in the Q&A right now to be sure and get them in. We've got another question that has come from students. This is an interesting question. If it was in the 2008 financial crisis, or if it was during this period of COVID, were you ever scared for the future?
Yes. So I think, to be very honest, anytime you deal with the unknown, it is quite a natural sense to be fearful. And it's not fear as in I didn't think we wouldn't get through it. I think one of the things we know is there were many people working very hard. People at the Federal Reserve were working very hard to make sure that people had access to cash, that bankers were able to work with their customers. There were people that were working hard to say, how can we make sure that those that have lost their jobs will have a lifeline, that small businesses that were asked to shut down. The fear that we all felt was, what does it mean for us and when will it be over? It has been a tremendous testament to, I think, the medical profession in this country, the study of science, how quickly we were able to develop vaccines to respond to this. And so at times when you're in that period of uncertainty, at times when you're not quite sure how you're going to come out on the other side, is really a time to remind yourself, what do I know? And I think here at the Fed, one of the things we kept our eye on was we have a value in serving the public. We're going to make sure that whatever we can do, we will do. So for example, when people were sitting at their kitchen tables, and Tim, some of us are still there as we're trying to make sure, even though we're in different places, even though we don't have access to some of the same resources, we know what's important to us. And that, I think, was reassuring. It was reassuring to me to say, we're not helpless. We will figure out how to do what we can do. But any of these kinds of shocks, changes that hit our economy are certainly unsettling. And I'd be lying if I didn't say, yeah, it sort of causes you to step back and say, okay, what is it I need to do now to keep us moving forward?
Question about the definition of full employment. And I guess the question I would have is, how, as a policymaker, are you and your counterparts gauging what's really going on in the employment situation? As you mentioned, some people have come out of the workforce. I know people personally who either they or someone in their family has some health issues, so they have had to step away from jobs, maybe because they do something where technology is not very applicable to that. How do Fed policymakers sort of try to wade through all that?
Yeah, it's a real challenge because the mandate that we were given by Congress is twofold. It asks us to make sure that the economy is able to operate in a way that achieves maximum employment while keeping prices stable. So one of the mechanisms that policymakers used to look at to judge, okay, what is maximum or full employment is, it would be at the point at which inflation began to rise. That would tell you the labor market is so tight that that must be full employment, that the ability to draw workers in was being traded off with having to raise wages and seeing inflation take off. It's been a long time since that dynamic has been present in the economy. And so I mentioned earlier, when we think about how the economy looked in January of 2020, 3.5% unemployment, a level that we had not seen in this country since the late 60s. That 3.5% unemployment told us something. We had low inflation and we had low levels of unemployment. That became a marker, I think. And when the Federal Reserve went around the country a few years ago in what we called Fed Listens, we asked people, how do you understand what the Fed does and what's important to you? And almost unanimously we heard jobs are important. Jobs and the ability to earn an income, a living wage is so important. And so right now, my colleagues and I refer to full employment as a broad and an inclusive definition. It doesn't have a number attached to it right now because we know during a time like this, there are shifts in the economy. 8 million people fewer are working today than were working with that 3.5% unemployment. We'll want to judge what's keeping them out of the workforce. When will they come back in? We'll also want to know for those people that the question described, which is, I've had to drop out of working, and we've seen many women, for example, drop out of the workforce to take care of family members. What will it take for them to come back in? So this will be a process of learning, of watching the information, the data that gets reported. It will also be a function, and one of the things I do in my job is to talk to people that are hiring and to talk to people that are looking for work. That's how we will understand, I think, what are the dynamics that are going on in that labor market that will signal to us how the labor market is unfolding and when we think we've reached something that feels like full employment.
Well, thank you very much for your comments. That brings us to the conclusion of the question session. I didn't know if you had any brief closing remarks before we turn the program back over to Trudy.
No, I just want to thank everyone for participating tonight. It's been a pleasure to talk with you. And for those of you that are educators, for those of you that are students, you're making one of the greatest investments, I think, to the future of our economy and to the economic well-being of our country. So my best to all of you. It's good to be part of the program.
All right, thank you. Trudy, the floor is yours.
All right. Esther and Tim, thank you so much for being with us this evening. And I want to thank our audience, all of our guests, for joining us as well. A recording of this event will be available on our website. So if you have colleagues that might be interested in this program, do feel free to share this information with them. They'll be able to see each of our programs since January of this year on the website and can share that and use it. Certificates for this program will be emailed to each of you. And you'll also receive a short evaluation form. We would appreciate it if you could share that form, complete that form, and return it to us once you've gotten it. As a thank you for participating in tonight's event, you will be entered in a contest and be able to win one of 12 prizes featuring Fed swag. And these are specialty items unique to the 10th Federal Reserve District. Winners will be selected randomly and announced in a follow-up email. Please follow us on social media and check out our website for access to free classroom-ready resources related to economics, personal finance, career education, and more. And speaking of our website, I will mention that it has been recently relaunched with an entirely new look and feeling and updates to the education site. We encourage you to visit it to learn more, and then let us know what you think. If there's ever anything that we, myself and my colleagues, can do to assist you, please reach out. Well, I think that's it for this evening. Thank you again for joining us, and have a very good evening.